The largest public company in the United States, NVIDIA, recently posted 85% revenue growth. Yet, right beneath that explosive digital expansion, the physical economy is showing severe stress fractures. Major retailers like Target and Walmart are issuing warnings about fading tax refunds and higher oil prices squeezing their customers. Meanwhile, hardware suppliers like Home Depot and Lowe's are watching their same-store sales flatline. Investor Steve Eisman recently highlighted this tension, noting that inflation has pushed the 10-year Treasury yield up to 4.6%. That rising cost of capital creates a dangerous pressure cooker for the stock market. Investors are left questioning whether they are riding a genuine technological boom or buying in at the peak of a speculative bubble. Professional investors rely on a specific dashboard of historical indicators to diagnose the market. One of those pillars measures valuation extremes. Right now, the Shiller-Cape ratio sits above 40, a level reached only during the peak of the dot-com era. Then there's the Buffett indicator, which compares the total U.S. stock market value to gross domestic product. It is currently sitting at roughly 221%. To track the total market temperature in real time, search and download the Buffett Indicator iOS app from the Apple App Store. But high valuations alone don't trigger crashes. Markets can stay expensive for years. Identifying when that valuation becomes unsustainable requires looking past the secondary market and into the primary market, specifically the IPO cycle. The mechanics of a top are driven by the market timing hypothesis. Corporate managers, venture capitalists, and private equity firms possess superior information about the intrinsic value of their own companies. They choose to list their shares on the public market exactly when valuations are irrationally high. This creates a hot IPO market, characterized by extreme first-day price jumps. In 1999, the average newly listed stock spiked 65% on day one. Issuers often use that massive initial return as a marketing tool to generate headlines and trigger retail fear of missing out. For the individual investor, this dynamic creates the winner's curse. Investment banks allocate the best IPO shares to their institutional clients. If a retail investor can easily get an allocation in a highly hyped IPO, it is probable that informed institutions have already passed on the offering. IPO booms function as a distribution mechanism, allowing insiders to offload expensive equity, while retail investors provide the necessary exit liquidity. This chart tracks the profitability of newly listed companies over the last century, revealing a reliable signal of market exhaustion. Massive spikes in unprofitable companies aligned perfectly with the peaks of 1929, 2000, and 2021. Look at the months preceding the 1929 crash. Wall Street was flooded with investment trusts, leveraged vehicles that allowed retail investors to pool capital. By August of that year, these speculative trusts accounted for 60% of new security issuance. By the height of the dot-com mania in 2000, roughly 80% of newly listed companies were unprofitable. The market aggressively capitalized losses, valuing internet startups on clicks rather than cash flow. In 2021, that exact profitability inversion returned. Global IPO activity broke all previous records, driven largely by special-purpose acquisition companies, or SPACs. These shell companies allowed pre-revenue businesses to list based on revenue projections 5 or 10 years into the future. When the primary market aggressively funds businesses with zero history of profitability, it indicates a detachment from the real economy. Historically, a systemic collapse follows. There is one significant counterexample in the historical data. The 2008 Great Financial Crisis was not preceded by a massive public equity IPO boom. The 2008 crash was built on complex debt instruments and securitized housing assets. The speculative frenzy happened inside the bond market, masking the true danger from those only watching the stock market. This dynamic connects to Steve Eisman's modern warning. With software companies facing disruption from artificial intelligence, the true systemic risk today might be hiding in the massive debts held by private credit and private equity firms, which remain out of view of the public exchanges. While an IPO boom is a reliable signal for a stock market peak, investors must also monitor hidden credit leverage to capture the complete picture of systemic risk. Bringing all this data together, the current dashboard paints a specific picture. We see extreme overvaluation with the Buffett indicator past 210%, rising macro pressures from climbing interest rates, and the ongoing digestion of the unprofitable IPOs from the 2021 boom. For the individual investor, the defensive playbook is straightforward. First, avoid the initial pop, wait for the flop. Wait 6 to 12 months before buying a newly public company. This allows insider lockup periods to expire and forces the company to report actual earnings data. Second, use aggregate IPO data and gray market premiums as a macro warning signal, not a shopping list. A flood of unprofitable new listings indicates broad retail euphoria and should prompt a move to de-risk. Flashing valuation metrics and an IPO boom are the market's way of declaring a shift from investing to speculation. In these environments, the strategy is to preserve capital and wait for true value to return. All analysis is based on publicly available sources. This is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence. To access more advanced research, applications, and our latest published personal intelligent deep value intelligence, explore and join the deepvalues.ai community. And if you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.